Thank you for joining the first instalment of our On Top of Tax webinar. This supplements our monthly newsletter that many of you receive. And what we're going to do over the next hour is give you a quick run through of some headlines and deadlines. So hopefully you can keep up to date with some of the important tax changes before they start to bite. And then we're going to have a slightly deeper dive into a few issues that are definitely relevant to today's agenda, so that you've got those on your horizon scanning and build those into decisions. And we're going to have a quick Q&A at the end of the session. So if you have got any questions, at the bottom of Zoom, there should be a Q&A box for you. So please feel free to post questions in there. We may not get to all of the questions in today's session, but we will endeavour to come back to you with answers to those in short order. Next slide, please. So I'm joined today by a very learned crew. I've got with me Richard Hogg, who's one of our VAT partners, who's going to take you through some topical developments there. Stephen, who's not speaking, but will be joining our Q&A session at the end, who's one of our customs specialists. Siobhan, who's going to provide detailed updates on some of the key national minimum wage matters, which, given last week's announcements, are very topical at the moment. And my colleague Eche, who's one of our R&D specialist directors, is going to talk through some of the changes to the merged R&D scheme there. Next slide, please. So the agenda for this morning trailed most of this. I'm going to do a quick run through of some key corporate and personal deadlines, and dip into what we might see in next week's budget. Then Eche is going to take over the mantle and talk through the R&D changes, followed by Siobhan, followed by Richard, and then we'll wrap it up with a Q&A at the end. So on to the next slide, please. So some of the dates for your diaries, just to make sure that you're on top of these. So on the corporate tax side, as I think most of you know, we've got the Chancellor's spring budget next week on the 6th of March. We'll have a look at what we might expect to see in that a little bit shortly. And then over March and early April, there's various other deadlines that you need to make sure you've got on your radar. If you're a very large group for quarterly instalment purposes, 14th of March, you've got an important deadline with the first quarterly instalment due for December year ends. And then if you're a large company, so not very large, on the 14th of April, you've hopefully got your final fourth quarterly instalment due for December 23 year ends. Towards the end of March as well, there's an important deadline that, again, those responsible for tax affairs will need to watch. You've got your 2-year claim deadline coming up at the end of March for March year ends. So this gives you a small window over the next month to adjust things like R&D claims, capital allowances claims, loss relief claims, just to make sure that your position is optimized. And quite a lot of those, if you don't make the amendment by 31st of March, you'll miss out on some tax opportunities. 1st of April, we've got the new merged R&D scheme starting, and Eche will talk you through that in a little bit more detail in a few minutes. And then early April, 14th of April, we've got a CT 6061 deadline. So if you're paying interest or royalties to overseas entities and you've got withholding tax compliance to deal with, for your quarter ended 31st of March. That's your deadline for payment there. Okay, next slide, please. On the personal tax side, we've still got the budget kicking around. We may or may not see some tax cuts in advance of that. 2nd of March, so Saturday, you've got your deadline for paying self-assessment if you haven't already done so, if you want to avoid the 5% surcharge. 31st of March, we've got, to all intents and purposes, the practical deadline for things like purchases of EIS, SEIS and VCT investments to give you tax breaks for your personal tax return. And then 5th of April, as many of you will be aware, we've got deadlines for things like payments into ISAs if you want to make use of your allowance, and also the deadline for using up your exemptions on IHT and capital gains tax to make sure your position is optimized there. And then we start a new year, as we all know, on the 6th of April. So let's have a look at the budget. I think with all the commentary that is going around at the moment, the expectation is that the Chancellor is unlikely to have much wriggle room for significant tax sweeteners in the run-up to the budget. But what might we see? I think what we'd all like to see is a coherent long-term plan. So some stability for business so that we can actually make some proper strategic decisions from a stable base. I think what we're going to see is more likely to be some tinkering around the edges, some repositioning of stuff that has already been announced just to make sure it's on people's radars, and possibly one or two tax breaks. On the business side, I think we're going to see a lot more noise around investment zones and how they're going to be useful for boosting the economy going forward. As we know, there's a consultation that's been proposed on what's known as the tourist tax, so VAT-free shopping, should that be reintroduced. We may see something like that. There's certainly from industry, there's a big cry for bringing that back in. There's been some noise around whether or not we have this VAT registration threshold and tweaking around the edges. So at the moment, we've got a bit of a cliff edge where when you meet the threshold, you're in VAT, but up to that threshold, you're outside of it. We might see some tinkering around that. I personally think that's unlikely. And then I think there's going to be various other tweaks targeted to specific areas, whether it's EIS or share schemes or some of the Pillar 2 stuff. We're going to see a bit more noise around over the coming months. On the personal tax side, I'm sure we'd all like to see NIC and income tax cuts. I think what's more likely is that there will be some statements about the cuts that have already been announced and what that is doing to boost individuals' purses and the economy as a whole. A lot of us would like to see some tweaks to the high income child benefit charge that gives that unfortunate 60% marginal tax rate. Whether or not that will come to fruition, we'll have to wait and see. And then I think there'll be some other tinkering around the edges with things like British ISAs, possibly some more help for first-time buyers, given the state the property market is in, and possibly something around the NatWest shares and boosting the Treasury's coffers via a public offer. All speculation, but if you join us on the 7th of March, we will have an in-depth analysis of what's gone on in the budget and how it affects you, and more on that towards the end. So that's a quick update from me. I am now going to hand over to Etchi, who is going to take us through some of the R&D changes.
Thank you, Neil. Good morning, everyone. I'm Etchi Aksa, a director in BDO's Innovation and Technology team, and I will be taking you through some of the recent R&D reforms, not just those that have already come into effect, but also the ones that are going to come into effect later this year. For those that are not familiar with R&D incentives, these are designed to encourage innovation and promote increased spend on R&D activities for companies in the UK. And over the years, the Treasury has shown continued support on all of the regimes by increasing the benefit that has arisen from R&D incentives and an effort to really further boost innovation to occur in the UK. However, unfortunately, these incentives have also been subject to error and fraud. And as a consequence, the R&D world has been quite busy in the past 12 to 18 months. HMRC's detailed statistics published last year on the levels of error and fraud in R&D claims estimated that the overall level during the tax year 2020 to 2021 was around £1.1 billion, and that the majority of these were non-compliance on the SME-based regime. During last year and following consultation, HMRC detailed that the actions that it was intending to take in an effort to sort of counter this error and fraud, which included changes in the overall approach, the submission process, changes to the regime, and also by hiring additional R&D inspectors. Their intent is to help businesses to get their R&D claims right, but also, in their eyes, to protect businesses from unscrupulous agents who try and pressure companies into making non-compliant claims. HMRC also wanted to refocus R&D incentives to qualifying activities undertaken in the UK, which is similar to R&D schemes in other jurisdictions. So what have the changes been so far? Well, the first change was the change in the relief rates. We saw that effective on all expenditure from 1 April 2023, we saw the benefit arising from the SME regime go down and the R&D expenditure credit, the RDEC regime, go up. This resulted in a significant reduction in the difference between the two regimes and was a clear step towards a merged scheme. At the same time, we also saw the introduction of the new R&D intensive scheme. In order to qualify for this scheme, a company has to be a loss-making SME and meet the intensity conditions whereby the relevant R&D expenditure must be greater than 40% of the relevant expenditure in the period. Companies that qualify under this regime will be able to get a repayable credit of around 27%, making it significantly more beneficial than the current SME and RDEC schemes. For accounting periods starting on or after 1 April 2023, we also saw the introduction of new expenditure categories, including data and cloud hosting costs. We saw the introduction of a new science area around pure maths. But also, we saw that companies that had previously not submitted, there was now a requirement for pre-notification. Now, whilst this does not necessarily apply for companies that have been claiming year on year, they can still be impacted. For example, a company that has historically been claiming claims, that have been making claims, may choose to hive out one of its divisions into a new entry, which doesn't have that historic claim position, and therefore will be subject to the claim notification requirements. Another significant change was the submission process, whereby HMRC introduced the Additional Information Form, or AIF, from 8th of August 2023. all companies must now submit an AIF before submitting their R&D claims in its tax returns. The forms are quite prescriptive in respect to the information that needs to be provided, not just in terms of the financial information, but also details of the R&D agents or those involved in the R&D claims, as well as the number of technical summaries that must be presented depending on the qualifying expenditure. You may have heard in the news that in the first months of this change coming in, approximately 50% of the R&D claims had been rejected by HMRC as the correct submission process had not been followed. So what's on the horizon? Next slide, please. The introduction of the new merged R&D incentive was or is still scheduled to take into effect for accounting periods starting on or after 1 April 2024. However, interestingly, whilst the 2024 Finance Act received royal assent on the 22nd of February, the date for the introduction of the merged scheme was left blank, which pulls into question as to whether the introduction could potentially be delayed. But at the moment, there's nothing to indicate that it won't happen from 1 April 2024. So in respect of what the merged R&D scheme will mean, well, the good news is that the definition of R&D has not changed, oblique the inclusion of pure maths. And in order for a project to qualify, it must be seeking a scientific or technological advance and must be resolving scientific technological uncertainty. The merged scheme will be based on the existing RDEC scheme, i.e. it will be an above-the-line credit at a gross RDEC rate of 20%. Similar to the existing RDEC regime, it will still be subject to the 7-step calculation before any potential cash is due to the company. Whilst this does not impact companies already claiming under RDEC, this will be a new concept for SMEs claiming under the merged scheme, and it will be more complex and less flexible in respect to how the benefit is recognised. The good news is, for loss-making companies, there is an effective or net RDEC rate. The effective or net RDEC rate will be higher than the tax-paying companies. The above-the-line credit is for loss-making companies will be subject to only 19% corporate tax rate, whereas it will be 25% for those that are tax-paying. Importantly, all companies will also be able to claim on qualifying projects that receive the grant or subsidy. This historically impacted SMEs' ability to be able to claim under the SME regime. And like the SME scheme, all companies will now be able to claim for contracted out R&D, which historically was restricted to individuals, qualifying bodies or partnerships for those claiming under RDEC. HMRC are still intending also that overseas costs for externally provided workers or subcontracted activities that were initially undertaken overseas, these will now be excluded unless it meets certain exemptions, again coming in for accounting periods starting on or after 1 April 2024. For the R&D intensive scheme available, that's available for loss-making SMEs, there was also some good news as it was announced that the required R&D intensity will be lowered to 30%, meaning more companies will be eligible to claim. I wanted to briefly come back to the contracted point, however, because the ability to claim contract R&D will need to be considered carefully, as it will be more complicated than just simply stating in a contract between a customer and its contractor that it is outsourcing R&D. HMRC have recently released some draft guidelines along with examples on who would be eligible to claim between the customer and its contractor, and we're expecting this to be finalised later this year. All companies will need to consider this carefully, especially as there's a conflict between where one company may be subject to the old rules and the other subject to the new rules under the merged scheme. Next slide, please. So in summary, there's an increased scrutiny from HMRC on R&D claims, resulting in more inspectors and a more prescriptive submission process. And the move from SME and RDEC schemes to the new merged scheme will need to be considered carefully, as the transition period is likely to cause confusion. So I'd like to do a quick poll. Francesca. So the poll is, how comfortable are you with the changes that will impact, that the changes will impact your R&D claims, or what that will mean for you? Okay, great. Well, it looks like some of you are very, very comfortable, but a lot of you feel that possibly there's areas that you're not 100% sure on, and therefore will need some further information on, and quite a few of you are still not really comfortable as to what this will mean for you going forward. Thank you. I'm now going to hand you over to my colleague Siobhan, who will take you through our employment tax updates.
Thank you. Hi there, I'm Siobhan. I am a national minimum wage specialist within our employment tax team, and I'm going to cover some upcoming compliance dates for employment tax, a bit more detail around national minimum wage and the upcoming changes there, and some things to look out for coming up in the future. So key dates here: 19th, 22nd of April. Well, probably everyone is aware, your monthly RTI payment dates. 5th of April, P46 car, so that needs to be submitted by the 5th of April for any details of any car changes for your employees in that quarter. And the 5th of April is the last date to register for payrolling benefits in kind for the 24-25 tax year. And I'll speak a wee bit more about that as we move through. Can I have the next slide, please? So another date to keep in mind is the 1st of April, as that's when the new national living and minimum wage rates come into effect. There's also a change to live-in domestic worker exemption rules from the 1st of April as well. So the rates that are there, quite significant increases across the board this year, which I think has been not too surprising, but maybe a wee bit more than was expecting. The 18 to 20 has went up to £8.60, and it's now 21 and over rather than 23 and over at the higher national living wage rate. The accommodation offset, if that applies, is not quite a nice round figure of £9.99 per day as well. One of the things that does catch people out on when the rates increase is that the new rates apply on or after when the next pay reference period comes in. So if your pay reference period covers over the 1st of April, you start paying the rates from the next pay reference period. If your pay reference period starts on the 1st of April, you will of course make that payment from the 1st of April, the increased rate. That's something that catches people out quite a lot, and you might find that you have some of your workers that come to you and say, I've not had my wage increase, because the date's always focused around the 1st of the month. So a bit of comms out to workers around this time, if that is going to be something that their increase is going to be just slightly after the 1st, is absolutely fine, but as long as they're aware that that's the case. The national living wage, this has been the highest ever increase. As I said, it's went up to anyone that's over the age of 21. And whilst that's obviously a welcome rate rise for those that are on that age 21, 22 bracket, it does have a significant knock-on effect, not just to additional costs to a business, but there may be people within that bracket who were in existing schemes, salary sacrifice schemes, and this rate increase has now meant that they are going to be unfortunately no longer eligible, because the amount sacrificed is going to bring them below the national minimum wage rate. Some conversations we're having just now with people around that, it's kind of minimised some buffers for people that they had available to enter into such schemes. So something to think about as well. And another change, as I said, the live-in domestic workers. Previously they were this is your au pairs, nannies, if they lived as part of a family unit as a live-in worker, they will now be entitled to national minimum wage for all hours worked, and obviously everything else that comes with the complexities of the national minimum wage compliance. So some things to look out for at this time when you're looking at the increase. As I said, the increase is having a significant financial impact, but what some people don't always realise is what counts as pay for national minimum wage purposes. It's not the same as gross pay, it's not the same as net pay, it is national minimum wage pay. So there are certain allowances, certain premium rates, certain payments that are made month on month to people, which, although it makes their wage much higher, doesn't actually count for national minimum wage purposes. So that's something that people can quite often overlook and assume that they are paying a much higher rate of pay. There's the opposite of that as well, where some people are already making these payments that do count and therefore give a higher rate of pay, and they just need to make sure that so long as they're paying the minimum, but it might not mean as much of an increase to their financial outgoings if they know exactly what counts and what doesn't count in terms of pay. At this time, ahead of introducing any increase, we would always recommend looking at policies, processes, controls, making sure that they're all up to date, that they're being utilised, and they're also understood as well. I have lots of conversations with people that have great policies. However, that national policy has been interpreted different, with local practices being interpreted, people not using the policy and creating their own local practices rather than following a policy. And that does cause some issues, especially around recording of working time, which is a key component of national minimum wage compliance. The other thing about that is, as well as having that policy being understood. So again, communications with workers, making sure that they're fully aware of why something can't be done, because it's, you know, a policy that's in place that they need to be aware of as well. And the other thing to be aware of is letters being received from HMRC. So we're seeing a flurry of activity from HMRC where they're sending letters out. These letters, they've got a slightly different request than some other nudge letters that HMRC send out. They're not asking for any response or any requirement for you to do anything other than go through a checklist of common errors on that. So it's one that can be, you know, forgotten about, put in a drawer. But unfortunately, these are, you know, sometimes a precursor to the knock on the door when an inquiry has been opened. So if you do receive any letters, we do ask that, although it doesn't ask for a reply to HMRC, that you do at least have a look through what it says and have a comparison against the checklist. So BDO, we're currently supporting people around that, understanding the full impact of national minimum wage compliance. It's not just about a rate of pay. I hear a lot of people saying, well, we're a real living wage employer, which is great, and it's really good that people are adhering to pay higher than the national minimum wage legal limits. But unfortunately, being a real living wage employer does still leave some element of risk if you don't have the correct processes around things, if you don't have a correct understanding of what counts or what doesn't count for NMWP, and can sometimes be an employer that is paying a higher wage that does get caught out. My favourite example of that is someone earning £90,000 a year who was effectively being paid £9 an hour because of incorrect controls around how much they were salary sacrificing. So it's not just about people that are on the minimum wage pay as well. The current compliance levels within your business. So if HMRC were to open an inquiry, would you be confident that your compliance levels would pass that inquiry without any cause or penalty and consequence? Do you have someone in the business that is being responsible for those checks, or are you relying on just the payroll flags? Now, whilst payroll software has evolved and it is able to identify these key flags for NMW underpayments, it doesn't give the full picture, and quite often we see people using contractual information rather than actual information through payroll. So the flags can give a false reading, or the lack of flags could give a false reading on that as well. And it's just something that more and more we're hearing people saying, well, that's a HR responsibility, that's a payroll responsibility, and it doesn't always join up. So making sure compliance across all those that are involved with anything that touches national minimum wage compliance is certainly a strong recommendation. And we're currently giving advice on people who are being proactive and looking at historic issues, trying to put things right and trying to keep that process compliant going forward as well. There's continual involvement on HMRC approach, but also there's legislation updates as well. So there's certainly things that people have been happy and compliant with 5 years ago that are now no longer fit for purpose. And putting things right historically is key as well, because a common thing that happens is people don't put things right in the right way, in which case HMRC, if they were to identify that as part of an inquiry, can still apply penalties, even if you've thought that you've rectified the issue as well. So getting things right when you're trying to put things right is also key on that as well. Just going to do a quick poll just now, if we've got that, Francesca. Okay, so just thinking about what I've went over there, and have a think about your own business. Which of these examples would impact national minimum wage pay? So deducting money from wages for a discounted car park permit, deducting money from wages for an off-site gym, having a dress code policy, deducting money under a salary sacrifice for a worker's pension. Okay. Good few answers coming in. So I'll be honest with you, this was a wee bit of a trick question. There's no right or wrong answer in theory. The first potential answer there, deducting money from wages for a discounted car park permit. It doesn't matter if it's discounted, it doesn't matter if it's the cheapest car park all the way around, and people are happy to do that. Any deduction that you make from someone's wage can have an impact on pay. So that would be something that, even though there's a benefit to the worker, there's still a benefit to the employer there, and HMRC could be looking at that to be something that could be a potential risk for an underpayment. Deducting wages for an off-site gym, again, yep. In theory, any payment that's paid over to a third party wouldn't have an impact, but an off-site gym doesn't necessarily mean that it's a third party. So again, an area you'd have to be careful of, even if that worker has happily signed up to that. A dress code policy, lots of places have them. It keeps things, quite uniform. But the imposition of having to purchase items to meet that dress code policy would have an impact on national minimum wage pay. And deducting money under a salary sacrifice for a worker's pension, yeah, the most popular answer there, that will have that. So again, even though the worker is happy to put all of their money into salary sacrifice for their pension, they can't be brought below national minimum wage. And the reason why I wanted to bring that out is just because under national minimum wage, there's no such thing as a allowable or a non-allowable deduction. It's the impact that has in pay, and that links back into your policies, your processes, and your controls as well. So we just move on to the next slide. We're seeing some HMRC activity. HMRC have always been quite active in the national minimum wage space. It's quite a political topic. They do get year-on-year funding, but we are seeing some of that adapt as well. So, about 2022, they started a geographical targeting. They picked certain locations across the country, and they focused on all the businesses that were in that area. They've conducted that across 10 locations, and we've just been made aware in the last couple of weeks at Liverpool, employers are set to be in the next round of targeting on that as well. They've always been proactive with specific sector targeting as well, and motor retail and accommodation sector are the two ones that we're aware that they're currently pursuing just now. So motor retail had letters that were sent out, again just with a checklist on them at the tail end of summer, and we're seeing accommodation come out just now. Now, accommodation is quite a broad spectrum. We know that it's going to hotels, it's going to restaurants with rooms. It's not just purely under like a hotel. So if you're in that kind of wider accommodation sector, and a letter comes through, then we would ask you to obviously look at the checklist and make sure you're adhering to what they're asking. And amongst all of this, they're also sending letters out to the workers. Not only are they doing that, they're doing some things on their social medias as well. And they've also been sending text messages out to workers as well under a Check Your Pay campaign. Now, this is crucial because workers will be looking at their pay and potentially not realising that there's certain other things that would impact pay, such as having to buy certain items to meet the dress code policy. And if the letters come out, it will give them all that information. It also gives them information on how to raise a complaint. And if HMRC receive a complaint from a worker, they are obliged to review that. They don't always open up the inquiry, but they do review every complaint that comes through. And it's all too often that the person that raises the complaint does open up the inquiry and ends up not actually being someone that was underpaid. But that inquiry is not looked at solely on the complainant, it's across the full business and potentially the full group. So again, just to reiterate that communications with workers, making them understand policies why and why not, and having that tight grip around things will potentially help prevent any worker complaints being raised to HMRC. Can I have the next slide, please? So another employment tax update, just to plan ahead. So if you want to register for payroll and benefits by the 5th of April this year, that will be for 24-25. But you will have seen that from April 2026, payroll and benefits in kind is going to be mandatory. So employers will have to payroll all benefits. Not quite sure yet if it's the end of the P11 days because we don't know about the beneficial loans and the accommodation benefits. They're currently not payrolled, so we don't know come 2026 what that's going to look like. The filing season, as I said, is approaching fast, so it is a good time to consider what steps you would need to take to move to payroll and benefits ahead of the 2026 mandatory deadline. BDO, we do have P11D software. We're one of the leading market providers of that, and we do have national tax employment experts who are on hand to help with any inquiries that we have around that ahead or in the current situation. And just now, I think I'm going to hand over to Richard.
Thank you very much, John. A brief update from me at the end around indirect taxes for everybody. So my name's Richard. I'm one of the VAT partners here. I think we've already covered off spring budget predictions. It's always hard to know what's likely to come up in the budget. The key rumours swirling at the moment, as Neil had said at the start, are potential increases to the VAT registration threshold and maybe a bit of targeted relief for certain sectors like tax-free shopping. The budget always includes consultations and an attempt to target tax avoidance or tax loss as well, so well worth looking at for those. Now, if we just move on to the next slide, what you will notice is that our timeline for VAT and indirect taxes is much briefer than everybody else's, and there's a good reason for that. VAT and indirect tax changes impact businesses in very different ways, and it's quite difficult to squeeze that all onto one slide. So I'm here to shamelessly plug an article that we have on the BDO website, which we prepare every single year and we update throughout the year. And what that article does is it summarises all of the VAT and indirect tax changes that you can expect to see over the coming year and actually beyond that as well. So I'm not going to go through all of the detail of that today, but I would recommend that if you want to keep on top of this, please do bookmark that page and revisit it regularly. Now, the way the article is structured is that it talks about a couple of key themes for plan change. So this is known legislation and policy changes. It looks at developments and consultations which are out there, and it also flags some interesting case law that you might want to be aware of. So just briefly to give you an idea of what the key themes are within each of those categories and the changes we're expecting to see. Within known legislation and policy changes, there are a number of changes coming into force which are still dealing with the implications of the UK's withdrawal from the European Union. So, for example, at the start of the year, we had some legislation which ended the supremacy of EU law for VAT and excise purposes. Equally, throughout the year, there are various milestones where new legislation is introduced to implement the Windsor Framework. And what this means is if you move goods from Great Britain to or from the island of Ireland, there may well be some changes that you need to manage throughout the course of the year. So potentially you could have some additional customs checks or certificates required during the course of the year. So please monitor that. Equally, if there are certain VAT simplifications, such as the VAT margin scheme for cars, which are being withdrawn because of how the UK's withdrawal from the EU were handled. So something to get on top of as well there. Within the key themes, equally, even though we've left the European Union, UK businesses still trade extensively with the European Union, and there may be new EU obligations for you to get on top of during the course of the year. A couple of examples for you here are the Carbon Border Adjustment Model, or CBAM. This is effectively requiring businesses to know and report the carbon footprint of certain products that are imported into the EU. So if you import into the EU, you could still be affected by this. Equally, there's a new obligation called the Cross-Border Electronic Services Payment Scheme. This is a transactional reporting obligation specifically for payment services providers, European Union obligation, which can affect UK businesses. And then finally, within that, there are targeted VAT reliefs, which are being brought in during the course of the year. Mostly these focus around women's sanitary products and energy-saving materials. Now, on top of the known legislation and policy changes, there are a number of consultations out there, and these are listed on the slide. Most interesting ones potentially to look out for are the VAT treatment of private hire vehicles, to make sure that everybody treats your taxi journey, for example, in the same way. There is a long-standing consultation outstanding on electric vehicles and the VAT recovery position associated with those. And finally, it's worth being aware, if you're in the gaming sector, that there is a consultation around how to report games. Finally, the article looks at some key case law developments and summarises some interesting appeals that we're expecting to come out of the VAT tribunals, which could be binding during the course of the year. So specifically, if you're in the tour operator sectors, or you have VAT recovery on deal fees, so transactional fees, there may be some interesting things coming down the line in 2020. So as I say, please do mark up, put that page in your favourites and keep checking it. We will update it regularly, and there'll be an update after the budget as well. Given the complexity of VAT and indirect taxes, that's the best place to go for it. And hopefully you can use that article to plan out what new requirements there are for you during the course. And with that, we're going to do a very quick poll, if that's okay. So this is our last poll of the day. Just looking at what do we think the biggest impact of VAT change, of indirect tax changes will be in 2024. So the question specifically is, what do you expect your organisation's biggest challenge on VAT and indirect taxes to be in 2024? And you can choose more than one of these if you'd like. Okay, we'll give it a bit longer. Interesting to see we've got quite a split. Managing international obligations looks to be the biggest issue on there, and that's certainly something that we deal a lot with clients on. Equally, there are a lot of changes. Yeah, interesting. Thank you very much. With that, I shall hand back to Neil, because I think Neil's going to do a bit of Q&A for us.
Thank you, Richard. So if I can ask all the speakers to come back on camera. Right, so we'll go to the chat first and the Q&A that have come up there. So Siobhan, I'll turn to you first. So there's a number of questions in the Q&A box that I think you cover, particularly those around salary sacrifice and the impact on national minimum wage. The one I'd like you to comment on is the question Roberto has raised around bonuses and commissions, and whether that additional pay is taken into account in national minimum wage compliance.
Yeah, thanks for the question, Roberto. Yeah, depending on what the bonus is. So a lot of NMW is not just straightforward, unfortunately. So if the bonus is a performance bonus, or if it's a long-term service bonus, if it's just called a bonus, like an attendance bonus. So the key is, what is the bonus actually used for? What does it cover? And if you pay like an annual bonus in 1 month rather than spread across the 12 months, that's treated slightly differently as well. So you have to look at that as well. Commissions, again, slightly different. It depends on the period of when the commissions were earned and when they were paid. So there are some complexities around that. Happy to have a more in-depth conversation, but a lot of this is around, again, how that's paid, what the intention of those elements are for as well.
Lovely, thanks, Siobhan. Question for Richard and Stephen. So you mentioned sort of international VAT, indirect tax compliance, and Stephen, with you on the panel, in terms of customs duties, a question I get asked quite a lot is how proactive do I need to be in managing these? Can I get my freight forwarder to deal with those on my behalf?
Thanks, Neil. It's a great question, and it's one that we hear a lot because freight forwarders do shoulder a lot of responsibility for businesses. But the critical thing to remember, I think, for everybody is that the compliance risk stays with the importer at all times. So what we would say is, while you can outsource a lot of the operational activity to a freight forwarder, you need to make sure you're giving them the right information at the right time, and that the roles and responsibilities of both parties are absolutely clear and understood. And as an importer, that you're undertaking some compliance checks on the work that is done on your behalf by freight forwarders.
Okay. Yeah, that's cool. And then I'll turn to you next, Eche. So the merge scheme, you highlighted the date. We're expecting at the moment for the new regime to come in 1st of April. And if you're a company with a December year end, surely we don't need to worry about those rules now.
Technically, yes, that's correct. Because if you have a December year end, the first accounting period it will impact is your 31 December 2025. However, it will be important to think about any projects where you may be working with third parties, or you may be subcontracting out parts of those projects. It will be important to start establishing how that's going to work, and ultimately who may be able to claim on that project, depending on the individual situation. Sorry, I realised I'm off camera, apologies. Yeah, it will depend on who's subcontracting to whom, what the sort of that relationship in terms of the contract is. HMRC will also be looking at the competent professionals. There'll be tests around IP, financial risk, that will all need to be taken into consideration. So it's worth thinking about those now, especially if you're going to have those long-term projects that are likely to go on beyond, beyond the start of their regime.
Yeah. And just sort of following that theme, so you mentioned when you gave your update the impact on small and medium-sized entities and the perceived abuse at that end. From the outside looking in, it looks like the government are really clobbering SMEs on the proposed changes. What's your take on that?
Yeah, good question. And the reason for that is because the SME regime has historically been significantly more beneficial than the RDEC regime. And actually, if you look into HMRC stats, that sort of 1.1 billion worth of fraud is predominantly associated with fraud in the SME regime. And if I recollect correctly, it's about 97 of that error and fraud was associated with companies making a claim under the SME regime and not the RDEC regime.
Yeah, that's helpful. And then Richard, just turning to you quickly, I don't know if you've seen Andrew's question in the chat about VAT Northern Ireland agreement from Jan 24. Is there anything you would like to comment on? I mean, I think you could probably do a whole webinar on that and Northern Ireland, couldn't you?
Yes, Northern Ireland remains extremely complicated. Thank you for your question, by the way, Andrew. The question is, what does the new Northern Ireland agreement from January 24 mean for VAT from Northern Ireland into Ireland? I presume this is by reference to the Windsor framework. The short answer is that the main impacts here are more to do with customs duty than with VAT. So Northern Ireland has a very, very complicated status from a VAT perspective. It is partly within the UK and it's partly within the European Union for VAT. The changes from January don't really impact the VAT position, but they do have more of an impact on the customs side. So it's predominantly looking at the movement of goods from GB to the island of Ireland. Is there anything you'd add on that front, Stephen?
Thanks, Richard. No, I think I just echo what you've said. There's lots of good things have come out from the Windsor framework and subsequently from the Safeguarding the Union command paper, but think it does remain a little more difficult than importers and exporters would like to move goods, particularly where you've got triangulation of GB, Northern Ireland and Ireland. And while we would say it is something that people should be doing and embracing the opportunities that come out of that, just exercise caution, a little bit like the question that Neil asked. It's something that it's easy to get wrong, and you would really want to make sure that your freight forwarders are lined up, customs brokerages lined up, and you know what documentation you're going to need and when you're going to need it to execute your strategies on this really well.
Okay. Thank you, guys. So I'm just looking at the Q&A. I think we've covered off most of them. David, you asked a question early on. Are there any indications of what tweaks to tax advantage share schemes might be? I think the short answer to that is no, not at this stage. So watch this space for next week's announcements. We are aware, and you're probably aware, that the government has been consulting on reforms to save as you earn plans and share incentive plans more generally to boost employee participation. So we may get some sweeteners in next week's budget on that. But have I got any intelligence on that at the moment? Nothing more than what I've said. And then a question that's just come in from Jay. Will the merged R&D scheme have any impact on the patent box regime? At this stage, we're not anticipating any changes to the patent box regime. But Etche, I don't know if you want to make any further comment on that from your perspective.
Yeah, no, and the simple answer is no. They are two separate regimes. Obviously, the onus doesn't go away in terms of the R&D leading to the patent needs to be undertaken in the UK. But no, the patent box and the R&D regime are independent of one another in terms of how they operate.
Okay, we'll leave the Q&A there. Francesco, I think you've got one or two more slides. So just to highlight some of the events that we've got coming up, I think we've mentioned a number of times, we're hosting a webinar on the 7th of March next week, 10 o'clock, to give you further insight into the budget announcements. Later on in March, we've got our usual tax support for professionals update. So that's a Zoom webinar where we'll be giving you some more useful updates on key deadlines, key case law changes, and having a deeper dive into a couple of hot topics that we're seeing across our client base. We've got an in-person Indirect Tax Club meeting in our London office on the 14th of March. If you happen to be in Newcastle on the 15th, you're very welcome to join our Tax and Industry Forum. And then we'll be regrouping on the 20th of March for the next in the series of these webinars to give you further insight and some more topics, probably on the back of what's announced in the budget. And then finally, on the last slide, we will circulate these slides so you've got those for your records and to refer to. But if you haven't already done so, I'd encourage you to sign up to our monthly newsletter and or join our LinkedIn group on top of tax group on LinkedIn, and you'll be kept up to date real time through those mechanisms. So with that,